Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Economists grew concerned over the weekend as the yield curve did its dreaded inversion. But, I hear you ask, what is an inversion? Well, U.S. government bonds have maturity or expiration dates set when they are issued, ranging from 1 month to 30 years. And each pays a certain coupon at regular intervals. The yield is the coupon payment divided by the price of the bond. In normal markets, longer-dated treasuries garner higher yields, as they carry more time-duration risk. When the yields of longer-dated treasuries fall below shorter-dated ones, it's known as an inversion. Inversions can happen at different points in the curve, such as between the 3-month and 10-year, or, in this case, the 20-year and 30-year yield. In the past, yield curve inversions have been harbingers for recessions. However, it depends on which ones you look at. The most commonly cited is the 2-year and 10-year inversion. However, as you can see in this first graph, the line which represents the 10-year yield minus the 2-year yield sometimes falls below zero, signaling an inversion. Yet that doesn't always line up with the gray areas, which identify prior recessions. A better inversion indicator that's been near perfect is the 10-year minus the 3-month yield. Right now, the worry is drawn from the 20-year to 30-year yield inversion. However, its ability to forecast recessions isn't very good. You can see how this portion of the curve was inverted for most of the 90s and multiple times before and after. Economists believe a significant amount of market gains in the decade after the Great Recession were a direct result of the Fed's easy money policies. And those same individuals see a major chunk of current gains driven by those same policies. So, if the Fed pulls them back, what do you think is likely to happen? The bottom line is this. Focus on the 10-year and 3-month yield inversion if you want to forecast pending recessions. A good proxy for the 3-month yield is the S-Gov ETF, while the IEF works nicely for the 10-year yield. In the meantime, consider adding inverse treasury ETFs like the TBT or financial stocks like the XLF or KRE ETF to your portfolio, which benefits from higher interest rates. That's all we have time for today on The Juice. Click, follow, and subscribe to The Juice email for your daily dose of market minerals.